the best performing properties, as you said, is the established owner-occupier market.
We have 3,500 landlords, and I have this conversation with them all the time, and it's quite illuminating for many of them. And I say to them, look, the irony of the property management side of our business is almost without exception, almost every single one of our landlords has actually made a better return on investment, before we even get to tax treatment, by the way, in the family home they bought for lifestyle reasons, than in the investment property that they thought they were buying to make money. And whenever you say that to a landlord, you can see them sort of scratch their head and look up in the sky and do the math, and they go, yeah, that's probably true for me too, right? So most of the best capital growth homes are not investment properties. They're owner-occupied homes.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Allen Wargent Property Buyers, and this week we have a very special guest. We've got Evan Thornley from LongView, the co-founder of LongView. So Evan, great to have you on the show.
Yeah, thanks, Pete. Great to be talking.
Now, Evan, sometimes when I get people on podcasts and webinars and interviews, you kind of struggle with the backstory or the background a little bit because people don't really have much to say. They, sometimes a bit plain vanilla, and they got a job in corporate, then they started investing in real estate. I can confidently say that's not the case in your circumstance. You've got a pretty colourful background and backstory. So now you're joining us from Melbourne today, but obviously you're not from Melbourne originally. Tell us a bit about your background.
Yeah, sure. No, I now live in the Democratic People's Republic of Victoria, but mate, I grew up on the Central Coast of New South Wales, actually, in surf country, right? So my parents sadly were early adopters of the wave of family breakdown epidemic that subsequently followed. Grew up in a single-parent family on welfare on the Central Coast of New South Wales, and through a range of good luck and hard work was lucky to get a chance to go to Melbourne and finish high school down here. And I came here to play music, actually. I'm a drummer. So the music scene was in Melbourne, but my band fell apart. So for want of something better to do, I went to Melbourne Uni to go to law school instead after the band fell apart. And that led me on to a business career. So starting at McKinsey and then to Silicon Valley. So I was, at ground zero in the early part of the internet revolution. And we ended up putting the first Australian tech unicorn on the NASDAQ, which was a search advertising business called LookSmart. Took it to 14 billion in market cap at one point, which was real money in those days. And retired and came home and tried my hand at politics. I care a lot about the country and how it works. And Premier Steve Bracks asked me to be part of his government, and I said yes. And then I quickly realised that was probably not my highest and best use. So left a few years later. But in the middle of that, I'd already set up a couple of public policy think tanks and other similar organisations. And our focus was a lot on early childhood development, which is a really, critical, the most critical, many would say, thing. And while we were trying to dream up good public policy and what governments should do about early childhood, the biggest childcare business in the world, which was ABC Learning, went broke. And so I'm like, well, hang on a minute, who's going to buy this thing? It's the middle of the GFC. No one's going to raise any money for this. Someone's going to buy it for 2 times earnings. Let's make it the good guys and let's turn it into a social venture. So I called my friend Michael Trail, who I'd known from Macquarie days and LookSmart days, who was then running Social Ventures Australia, and we set up the Good Start Consortium, which now owns, is still, I think, the largest early childhood education business in the world, but is owned by 4 charities and is run for the good of the kids. So very proud of that particular journey. But for the last 10 years, I've been trying to understand residential property and housing and why the whole system isn't working actually for anybody. And, on the one hand, we just got our hands dirty and started managing rental properties. And, there's no better way to understand how the system works than to really just get your hands dirty and get into it. And we now manage 4,000 rental properties at LongView. But the background music to that was always, why is there no investment grade fund to invest in this asset class? How can you possibly have the biggest asset class in the country have no investment grade funds? That never made any sense to us. And plenty of people have tried to answer that question too. And I've spent the last 10 years interviewing every suspect who's tried. and finding out what they did and figuring out why it didn't work. And I think we've engineered around that. So, so what we're doing, I think, is trying to do something that will become quite large scale, but also has a really sort of strong sense of why the housing market is not working for many Australians and what could be done to fix it. So it's dual purposed in that sense.
Yeah, it's been quite a journey. I imagine going into politics, although it's an admirable thing, I imagine it must seem very slow if you've been through the swings and arrows of the NASDAQ boom in the early days of the tech bubble. I suppose I guess the levers of power in politics, things move much more slowly. And I guess going back in to running your own show again, at least you can make things happen much more quickly. And as you said, there's been a few funds over the years, but there's been lots of things in things like student accommodation or more sort of niche asset classes, but nobody's really tackled the residential space very well. I'm interested to know, you mentioned your sort of early years there and sort of housing commission and single parent households and things. Was that one of the drivers for you sort of founding LongView and starting to try and find ways to solve the affordable housing crisis in Australia? Was that a key sort of motivating factor?
Oh, look, I think many of us are trying to, heal the inner child in a whole bunch of ways. I should say no housing commission in my case. That's Albo's backstory, not mine, but definitely growing.
I must have heard it so many times. It must have been imprinted on my brain.
I don't own a clifftop mansion in Copacabana either, but I used to live up that way in much more modest circumstances. But seriously, Look, I think my personal story is much more of an understanding of the centrality of family, which unfortunately for me was not, we had a very difficult and dysfunctional family background, and I only learned later in life from people who didn't what a good thing it would be to not have that. The foundational building block for a successful family life is dignified, secure housing. If you don't have that, it's bloody hard to make anything else work, and a lot of Australians don't have dignified, secure housing, and that's not just obviously at the most difficult ends of the spectrum around the social housing, other needs, though those are acute, but these days that's for a large number of people, and so and right across the spectrum, and so really our mission is to try and find ways to ensure that people get dignified, secure housing, whether that's in an owner-occupier context or a rental context. And in order to really prosecute that, you have to think very differently about how we would build a housing system that would really give people back control.
So you mentioned you've had thousands of rentals under management. I know you've done within the team strategy advice and buyers advocacy, helping people to buy homes. So you must have seen a broad spectrum of the housing market over all of that time and over all those thousands of properties. I was interested to read about your RODWELL approach, investing in robust older dwellings on well-located land. And you said in some of your website material, your data analysis shows land value drives capital growth above the house price index. So I was interested to read that because although we didn't have a catchy acronym, we do sort of follow very similar principles, what we do. And I was interested to know intuitively, we've done research over the years into the top performing suburbs and so on, and over 30 years of figures, you can generally see it's kind of landlocked locations and suburbs. But then within the suburbs, the data gets a bit sketchy because you've got a range of different properties. In Brisbane, we've got flood zones and so on. So how have you gone with the sort of research? So I don't doubt the approach because we use it ourselves, but have you managed to
Pete,
find any data to support that?
The first thing I'd say is, despite my Silicon Valley background and therefore obviously like tech and data analytics in particular, and time at McKinsey is very important to me, but so's what we call field experience, right? I mean, you would know some of the top buyers advisors who work with LongView, but we are passionate believers in the buying advisory and buying advocacy profession. We really, I think it's the most important job, and a good buyer's advisor does such a great service to their clients, and there is no substitute for being out on the ground, looking at every detail of the property, understanding the local market and all those things. So we've very much tried to blend art and science in that sense. We will never invest in a property without a senior buying advisor going and inspecting the property and really forming a view about, whether it's likely to generate outperformance and what the risks might be in doing that, as well as marrying that with, 7 years now of deep data science. So we have analysed every sale price of every property in the country for 50 years. And I think the magic is actually in blending the two. You can read a lot of stuff into the data and you can form some conclusions that work some of the time. But actually, when you go out on the ground, as you well know, the stuff that's not in the publicly available data or that you're going to read wrong, and, all property is local. There's no substitute for deep professional experience in that local market. So the conclusions we've come to and the work that we do every day very much involves both, and particularly views what I regard as our joint profession in terms of the buying advisory part of LongView as a really integral part of delivering the right outcomes for clients. So what do we learn? I mean, what we learn is that land appreciates and buildings depreciate, but nowhere possibly in the world more than in Australia, because we have the second highest population growth rate in the world, and yet, despite this wide brown land, we cram almost all of that population growth into just 3 urban centres: Sydney, Melbourne, and southeastern Queensland. And as a consequence, if you try and put more and more people on the same amount of land, the value of that land goes up, and quite quickly. And in Australia's case, has done so for 100 years. Whether or not interest rates are up or down, whether or not there's been negative gearing, whether or not there's supply side shortages and all of the other stuff, the gallons of ink are spent talking about, the real driver of Australian house prices is principally the value of the land underneath them. And so when you analyse the capital growth of every property in the country and you get the sort of bell curve from best through the middle through to worst, if you tried to characterise the types of homes that are in the top half, that are above average in capital growth, then that's where we came up with the RODWELL concept: robust older dwellings on well-located land. Not least because, to take our own portfolio in our home equity fund, 81% of the value of all of those homes is actually the value of the dirt underneath them, and that's what's driving the growth. So, and I think that's would be completely consistent with your experience, and that can change not just suburb by suburb, but that can change one property to the next one. I think there's too much focus on things like suburbs, actually. And a lot of the data analytics is fairly shallow and works at that aggregated level. But, as I always say to clients, you buy a property, you don't buy a suburb. And we, while we're investing, we've now got 118, we're doing 3 to 5 a week now, properties that we've invested in through our home equity fund. We look at every single one as an individual property and assess its likely capital growth performance.
Yeah, it's interesting you say, actually, because, when we've run stats over the years and we've seen the top performing suburb in Brisbane has been Wilston. But as I always say to people, look, within that suburb, you've got a whole range of different properties. Almost every suburb in Brisbane's got a busy...
As you know, we can find you good and bad properties to invest in every suburb in the city, right?
Or down your way, Copacabana, I think, Terrigal, the number one suburb. I don't think that's a big surprise. But even then, sometimes I think you want to focus at least as much on the actual asset or the property itself. Yeah. Because as you said, it's an imperfect market and there's always going to be good and bad.
Developers famously and sales agents, neither of whom, frankly, I trust, usually use suburb figures to justify, for example, why buying an apartment in a large new apartment development in that suburb is somehow going to get you good capital growth. And as you well know, nothing could be further from the truth.
And I suppose, the interesting thing here, I guess just zooming out a bit, is that usually when you see a lot of funds that invest in real estate, particularly commercial real estate, there'll be a lot of emphasis on the net yield, the weighted average lease expiry and so on. But I think intuitively, anyone who invests in Australian property knows that, yes, the rental yield kind of keeps you in the market, but it's the capital growth of the land that is delivering the big results over time. And I'm sure that's what your stats have shown you over time.
Very much so. And if you compare that with residential property funds in other parts of the world, you have to understand how different Australia is. There's a very large sector, for example, of single-family home funds in the US, that have literally got 100,000 individual homes in them. But they're mainly in the exurbs of the major cities of the Sun Belt of the US, where they're getting 10 to 12% gross rental yields. If we're looking at single-family homes in Australia, in our major cities, you're likely to be in 2 to 3% gross rental yield. And actually, particularly in places like the Democratic People's Republic of Victoria, some or all of that can be eaten just in land tax alone. So, every property market is a trade-off between capital growth and rental yield, by definition. Australia, at least Sydney, Melbourne and Brisbane and, Gold Coast and Sunshine Coast, are close to the best capital growth markets in the world, and have been since before any of us were born. But the corresponding reality is we're close to the shittiest rental yield markets in the world. So whilst the rental yield can be important to an individual investor in an individual property and in particularly meeting their finance, ain't no one's got rich on rental yield in Aussie resi. There are pockets like purpose-built student accommodation or disability housing where it's possible to do so. But in the great wash of the suburbs of Australia, the type of homes that almost all of us live in, the money is in the capital growth, and as a consequence, it's principally in the land.
For sure, I think there's a bit of Airbnb and stuff, but it's not very passive, and it's very
there's little niches.
intensive.
But if we look at the $12 trillion that is the Australian residential property asset class, 3 times the size of the whole superannuation system, 4 times the size of the Australian Stock Exchange, 10 times the size of the commercial property market. Of that $12 trillion, there's little tiny niches, student accommodation or build to rent or disability housing, all of which are individually less than 1% of the market, a lot less than 1%. The entire new construction industry is 3% of the market, right? Everybody talks about, debt-funded bubbles and mortgage and interest rates and yada, yada. That's only 22% of the asset class, right? So the vast bulk of the $12 trillion is equity in existing homes, and 60% of it is equity in existing detached houses. And so more than half of that $12 trillion is equity in existing detached houses, and principally the value of the land underneath those houses. So if you think you're investing in residential property as an asset class, then the straight down the middle of the fairway place to be investing is equity in existing owner-occupied homes. That's the biggest part of the market. That's not a niche. That is bigger than every other asset class in the country in and of itself. And so that seemed to be, to us, if you're trying to be a mainstream investor in residential property, what you should be investing in, because that's actually the bulk of it. And it's been one of the best performing portions of the market.
Well, that does make sense. I think over the years, when I've seen people go wrong with properties, very often been in properties that are marketed to investors. It's but actually the best performing properties, as you said, is the established owner-occupier market.
We have 3,500 landlords, and I have this conversation with them all the time, and it's quite illuminating for many of them. And I say to them, look, the irony of the property management side of our business is almost without exception, almost every single one of our landlords has actually made a better return on investment, before we even get to tax treatment, by the way, a better return on investment in the family home they bought for lifestyle reasons than in the investment property that they thought they were buying to make money. And whenever you say that to a landlord, you can see them sort of scratch their head and look up in the sky and do the math, and they go, yeah, that's probably true for me too, right? So most of the best capital growth homes are not investment properties. They're owner-occupied homes. There's a whole lot of other reasons why owner-occupiers look after their homes better. There's better capital growth there. There's no land tax associated with the principal place of residence. When you think about residential property as an asset class, owner-occupied houses on good blocks of land are actually far and away the most attractive assets in the asset class, as well as the biggest.
It kind of makes sense. In the areas you want to live, there's probably going to be a lot of demand, good school zones, leafy streets, that kind of thing. So that kind of neatly leads us into your home equity fund. So you've sort of given us a bit of the backdrop there, but explain to us, how does the fund work, and how does it make returns for investors?
Yeah, so some background firstly, and why did we create this fund, right? And it came directly out of the work we do with our landlords, right? We realised that most of our landlords, and nothing to do with us, we're just managing the properties. We didn't buy them for them in most cases, and we certainly didn't sell them to them. Most of our landlords have ended up making very ordinary returns on their investment properties, and first and foremost because they're in the wrong asset. They're in assets that don't have good capital growth. And then there are all the other costs and hassles and taxes with being a landlord. So we said, well, there's got to be a better way. Everyone wants to invest in property because it's safe. Compared to equities markets, the gyrations of the stock market compared to the Australian housing market, Australian houses is a super safe place to invest. And that's why we all do that. But there's got to be a better way than being an individual landlord of maybe one, or on a good day, 2 or 3 individual properties. You've got all of those risks. You've got a lack of diversification. You've got negative cash flow in many cases. You've got all of the hassles of being a landlord. So it's not a great way to make an investment. So we've really been trying to solve what's a better way for the 2.5 million Australians who do want to invest in resi property to do it better. And then for the other investors, including, larger investors right up to institutional scale who'd love to be invested in the asset class, but for whom there is no practical way to do that. I mean, what are they going to do? Buy thousands of houses and manage? Like, no one's going to do that, right? So that was the genesis of what we set out to do. And so then we systematically went through, well, what are the risks? What are the returns? How do we maximize the latter and minimize the former? And I think that's what we've done. And so we realized that actually the owner-occupied homes were actually the best assets. So how could we invest in owner-occupied homes? Well, it turns out that precisely because Australia has got super high capital growth, that leads to 2 realities. Most Australians either have too little home equity, that's mainly the next generation, who need a bank of mum and dad to be able to move ahead, or actually they have too much. And they're surprisingly wealthy, even by their own expectations, but so much of that wealth is tied up in their home and not accessible to them. So we said, well, we're happy to be on either side of that trade. We want to invest in the home equity. How would we like to invest in it? We'd like to invest in it if and only if it's the type of property that's going to get great capital growth. And if it is the type of property that's going to get great capital growth, then there's enough chocolates for everybody to be happy with the deal here. We can share the chocolates around. If you're in a $2 million home, that thing is typically throwing off $150,000 of new money every year, but you can't access that money, right? So we co-invest with homeowners. We give them access to some of the money they have tied up in their homes, and they give us a share of the capital growth. And so we're getting exactly what we want: exposure to high capital growth properties, no land tax, no landlord hassles, a diversified portfolio. Now we've got, as I say, 118 properties across Greater Sydney, Melbourne and Brisbane, Southeast Queensland. 118 properties in about 109 suburbs, ranging from 700,000 to 6.2 million on the waterfront in Gladesville. So a really incredibly beautifully diversified portfolio of homes, and with an investment that is there to harvest capital growth, because that's how money is made. And so even with one property, it's hard to harvest the capital growth. You kind of get it at the end. Across a large portfolio where those houses are churning 10 to 15% a year, you can then profit from that capital growth and actually see the cash flowing out of that capital growth across that portfolio. So that's essentially what we do. We co-invest with homeowners who want either access to equity to get into the home, but mainly who already have, in a sense, too much equity in their home and want to use some of that money for a whole range of other things. And they're willing to exchange that for a share of the future upside in the home. So nothing terrible can happen to them. It's not like things like reverse mortgages, where if you're not careful, the thing can eat you out of house and home. We're only making money if our clients are making money. We're only making, a typical deal has us get 1/3 of the future capital growth. So our investors only make $1 if the homeowner's made $2. How do you get that Goldilocks environment where both sides are happy with the deal, where we make money with our clients, not from our clients? It comes when the dirt does the work and is churning out that new value every year. No one has to do anything for it. Just sit on top of that block of land. And if it's throwing off a couple of $100,000 of value every year, then that generates enough outcome that both the homeowner and the investor can share in the profits effectively.
So that makes sense. So you're getting a share of the capital growth return, but without the fund itself carrying debt. So
None at all. Yeah.
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 So, but I guess on that basis, within the constraints of what you can and can't say with these things, do you have a kind of a fund investment strategy, a kind of an expected or target return for that type of investment?
Look, I mean, obviously, we built this thing to be, a blue chip investment grade operation with, independent trustees and top tier compliance and audit and other facilities. So everything's done under an Australian Financial Services license. So we have obviously got a large scale and fairly detailed investment memorandum. So when we set the fund up, we believed that we would likely deliver roughly double the house price index. So if houses went up 7% per annum, as they have for the last 40 years, that we were targeting about 14% per annum for our investors. In the first 2 years, we're starting to see the performance growing quickly, and the quality of the assets we've bought or we've invested in has meant we're doing better than that. So for the last 3 quarters, our portfolio has generated close to 5% returns per quarter. So obviously that's a very satisfactory result, and as a consequence, we're starting to get a lot of capital from our investors, and a lot of our existing investors are investing more on the back of those results, and so that means we're starting to scale up our ability to co-invest with homeowners. So we're now doing sort of 3 to 6 a week across the 3 cities, and I anticipate we'll be investing in dozens of homes per week, 12 months from now. If we can continue to deliver returns anything like that, it's hard to match that type of return in individual property investing with all of the costs and hassles and taxes. And it's hard to have that level of diversification. So, and yet we're doing that without any debt in our funds. So there's none of the costs or risks of debt or interest rates or being sold up or any of those things. We have no debt in the funds. So it's been a long journey to put this machinery together, and we hoped it would all work as we anticipated, but until you actually get out there and do it for a couple of years and show actual results, you can't do that. But I guess it turns out we were even better at selecting the right assets than we thought we might be, which is gratifying because there's been a huge amount of work with both data science and with our colleagues in the buying advisory industry. And as a consequence, the fund's been performing better than we expected.
It's pretty exciting. I just reading the June 2025 update, performance 5.21% for the quarter, 12.78% for the year. It's interesting because that actually comes ahead of what was reported this week at the time of recording, a huge upswing in investor lending in the third quarter of the year. So I guess in the lead up to the deposit guarantee already, some pretty smart returns.
That sort of anticipatory behaviour from buyers, both investors and obviously first home buyers where they could. And then, as I'm sure you're seeing, Pete, that sort of low to middle end of the market now where the government money is flooding in, as we all said it would, is doing nothing but raise prices. So look, unfortunately, everything every government does to try and fix the housing problems, most of them don't fix the housing problems, but almost everything that any government does seems to make our fund perform even better. So, I mean, I'll give you a really good example, right? Obviously a lot of the focus of governments is they want, quote, more supply. And yes, we need more dwellings, particularly in the rental market, right? No question. But usually what they're looking for is higher density, and so more apartment blocks and so on, and that's probably the right public policy answer. But that's not going to make housing cheaper, because what it's going to do is mean that the land is even more valuable. And so, for example, in New South Wales, where you've got 171 new activity centres, where they've stripped away a lot of the zoning and planning restrictions so that people can build up quickly, and where they're starting to see the green shoots of more new housing supply, and that's probably what they're looking for. But what it means is that the homes in those zones are worth a lot more. And you're seeing, for example, what I call the club deals, where a bunch of neighbours get together, have a few too many sherbets around the barbecue and decide they're going to group together and sell their homes for 5 times what they would have got individually. So we had no foreknowledge of that policy. We had no inside information about where those zones would be. But since we invest in robust older dwellings on well-located land, it turns out that 21% of our portfolio in New South Wales has woken up one fine morning inside one of those 171 activity zones, and that's probably not even reflected in the current valuations we have for most of those properties till we start seeing transactions, and that comes through the comparative market analyses. But we're expecting those properties to significantly outperform the market as the new money from the feds helping first home buyers is going to help that section of the market significantly outperform. So for better or worse, it seems that everything that governments do to try and sort the housing problem is making the value of well-located suburban land higher, and as a consequence, the LongView Home Equity Fund is going to do even better.
Yeah, well, given your political forays, I maybe won't delve into Albo's policy mix on housing, but just before we sort of wrap up and let people go and check out the fund for themselves, I had sort of a triumvirate of questions on the mechanics of the fund. So presumably you have to go through a revaluation process on a quarterly basis.
Absolutely. So we revalue every property every quarter. I mean, that's the heart of what the fund is about. And as you would understand, we do this for a living. We buy homes for a living. So we inside the company do a revaluation of every property every quarter with our internal registered valuers and our senior buyers advisors and our data science. We then get a set of external independent valuers to pick a random sample and value them and check them against our values, and they become almost identical every quarter. And then the ultimate test, of course, is when those clients sell their homes. And so we've had 6 clients so far have finished their contract with LongView, either by selling their home or by buying us out of our share of their capital growth. And 4 of those have been sales. So it's only 4 data points, but the first 4 properties that we co-invested with where the client has then sold the home, in all 4 cases, actually, they sold it for more than we had in our most recent valuations. So we feel pretty confident that you know what it's like, Pete, as a professional. You know what an established home in an established suburb is worth, plus or minus a few percent. So, we had a lovely classic sort of Rodwell in Bexley in southern Sydney, 5 minutes walk from the station. That sort of classic dark brick 1940s, probably with a big backyard. We co-invested with the client at 1.5 million. We'd revalued it at 1.7 at its most recent valuation because it was clearly going to do very well, and the client just sold it for 1.8. We had another one this is also in Sydney, but in Killara, North Shore of Sydney, 1,100 square metres with 1940s family home at the west end of Killara near the golf course. We invested at 4.225 million. We had revalued that in the most recent quarter at 4.5 million. The client just sold at 4.6. So, the very dynamics that you deal with every day in your professional work, as we do, if you can pick the eyes out of the market and invest in those properties, and then you have the benefit of balancing that across a widespread portfolio. So we're not trying to be too clever. Everyone says to me, do you think Brisbane will outperform Melbourne, right? And you can hear arguments on both sides, and the Olympics and the taxes in Melbourne, but then maybe Melbourne's really all that stuff. We're not trying to be too clever. We invest the fund in a balanced way. It's like an index fund in that sense. 47% of the money is in Sydney because 47% of the money in resi property is in Sydney. 31% in Melbourne, 22% in southeast Queensland because our investment approach is so powerful. We don't need to try and get too clever and outsmart the market on questions like which city. We should just give our investors a balance across the cities in exactly the same way as the market has allocated capital across the cities.
Makes sense for a longer term investment. You preempted my question on realizations and just on fees. You mentioned before that for an individual landlord, there's a big drag from holding costs and property management and repairs and everything. But presumably your fund is largely generating fees from performance rather than management.
Totally. And again, let's be clear. Owner-occupied homes, by definition, outperform, even if it was the exact same asset as a landlord-owned property. Let's just start with land tax, right? I mean, if you own a material amount of property in the Democratic People's Republic of Victoria, that's 2.65% per annum. right? I mean, you'll never recover that back. Like, you just murdered on land tax alone, let alone all the other costs. So, and then because we're co-investing with owner-occupiers, of course, it's their home. They manage the maintenance, they manage the rates, the insurance, all those things, as they always have. So there really is no material expense base there compared to what we have as landlords. There's no rent either, but it's all about the capital growth. So, yes, and so look, we've tried to create a system which is completely aligned, where the investors, the fund manager, and the clients, we all make money the same way, and we will all succeed or fail in the same way. If the property does really well, the investors will do really well. The fund manager, who's paid mainly with performance fees for outperforming the market, will do well. And the clients, by definition, will do well because they own most of the capital growth still in their home. So we've really tried to, we have a philosophy, I guess, that we make money with our clients, not from our clients. And I think, honestly, that's pretty different to a lot of certainly the real estate developers and the real estate sales agents, and the banks. They all make money from their clients, not with their clients. We make money with our clients and with our investors. So, yes, the bulk of the returns for LongView from the fund come from outperforming the property market, and the investors then give us a share of that outperformance.
Cool. And is there a de minimis investment period, a couple of years?
Well, not for our investors, no.
No?
Again,
Okay.
This is one of the many advantages of being in a fund as opposed to an individual property. So we will have, starting next quarter, starting in the first quarter of next year, we will have a quarterly liquidity facility. So a quarter of all the new money we raise for our fund and subsequent funds will quarantine for any redemption requests we have from investors in that quarter. If they need to get their money back out, we will get that out as first call on that money before it's invested in the fund. So, and then as the contracts are realised, as the owners sell or buy out our contract, all of that money, both the original capital plus all of the growth, will be returned to the investors every quarter. So I think counterintuitively for most people, when they hear what we're doing, they like the math, makes a lot of sense, but they sort of go, well, what will you do if people stay a long time in their homes? When am I going to see my money? It turns out, perhaps counterintuitively to that, this will throw off a lot more cash much more quickly, because 10 to 15% of the portfolio will churn every year. And so it's actually a much more cash positive way of investing in the asset class than being the individual landlord.
Yeah, that makes a lot of sense. So we'll put links in the notes, of course, but where should people go to if they want to read more about what LongView is doing and also about the fund?
Yeah, look, I mean, obviously it's all at the, longview.com.au website. You'll see, again, we're all about buying, managing and investing in property. We're not sales agents. We're not developers. It's all about established homes. So it's all there. You'll also see there, or if you just Google LongView/PEXA, we published 3 white papers before we launched the fund part of the business to really explain in great detail how we believe the housing markets actually really work. And so those 3 white papers, 2.5 years old now, I think they read incredibly well. The first one explaining that really it's driven by land value, which is driven by population growth, not so much by things like interest rates. We put that out just before the interest rates started rising, when Christopher Joy and all the bank economists were saying housing's going to crash, we're at the end of the bubble, and we said, no, it's not. And turns out we were right, they were wrong. I think we have some confidence in our fundamental thesis that the value of well-located suburban land is going to keep growing rapidly for as long as we keep trying to put more people on the same amount of dirt. And so our basic investment thesis is suddenly nothing changes. That's been happening for 100 years. We think it's going to continue despite all the efforts of all sorts of people to change that reality, and therefore you should get a balanced exposure to it. And that's what we're trying to do.
Yeah, I think we're singing from similar hymn sheets in that regard. I'll finish with a personal question. Evan, you mentioned you're down in the People's Republic these days, but any plans? I would have thought an entrepreneur such as yourself would be pining to get back to the surf beaches in Copacabana. I used to have boys' holidays up at Copacabana back in the 90s, but it's gentrified so much these days. But anyway, my question is, I expect one day you'll want to slow down. Are you going to stay in Victoria, or are you going to move back to the eastern seaboard?
That's an interesting question. I might say, like, when I was growing up, the Central Coast was, and I was part of it, the unemployment and sole parent capital of the nation. So
Umina Beach.
Pretty tough town. And to be honest, me and my mates were more likely to be down the Florrie bashing up tourists, wealthy tourists from Sydney, than joining them in their clifftop mansions. But I'm a reformed individual at this point. I guess I go back to the start. To me, the most important things are actually family and community. And part of my journey we didn't discuss, and it's not really relevant, but I'm actually a convert to Judaism, so I'm very much part of the beautiful, rich Jewish community here in Melbourne. And that's probably, of all the interesting things I've done in my life, the most personally satisfying. So I'm more rooted to community than place per se. So for me, those deep, rich relationships with close friends, close family, and community are the most important things in my life. And those people happen to be mainly here, except my daughter, who sadly is in Colorado with my new grandson. So but I mean, I'm up in Sydney and Melbourne the whole time. Sydney and Brisbane and the Gold Coast the whole time, and with business and lots of friends. So I enjoy visiting those places very much, particularly through the winter months, as I've done recently.
Fantastic. Well, I hope you've been following Ange Postecoglou at the Tottenham Hotspur Club, or at least until they binned him. So, plenty of Jewish supporters.
I have.
In the
I'm
club.
a Reds man myself, but and it was good until it wasn't in that particular situation. But yeah,
we'll edit that part. All right, thanks. Thanks, Evan. It's great to get all of your insights. So check out LongView's fund, and also their other services on their website. We'll link in the notes, and look forward to chatting again. Thanks, Evan.
Great, Pete. Great to talk to a fellow professional in the industry, mate. Enjoyed it very much.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.